Hello and welcome to the webinar from Super Return LP Co-Investments, Best Practice Tips You Should Know. This is Christopher Godfrey of CEPRES here. I hope that everyone can hear me okay, and if you have any issues during the session, please do contact the Super Return organizers to help you with that. Also, if you have any questions, we'd love to hear from the audience. We certainly don't want this to be a one-way interaction, and please submit those to the Super Return group. And with that, I'd like to actually thank Super Return for being our host today. We really appreciate them as a group. They provide, as we all know, great events, and I think it's very good to see this kind of digital online approach where maybe it takes us less time and less time out of our busy schedules. I would also like to thank my friends on the panel who are joining me today, and I'm going to do very brief introductions there of the panelists and myself, and then we'll get stuck into the content. So just to start off with, as I said, my name is Christopher Godfrey from CEPRES Group. At CEPRES, we support clients to evaluate, monitor, and measure the outcomes of their investments. And this includes co-investments, and we have quite a number of clients who are very active co-investors. And through that work, we have the single largest set of data on co-investments, and we're going to be sharing some of the results and outcomes of that through these sessions. But more than that, I'm very pleased to introduce to you our panelists. We have Will Scott from CPPIB, Hitesh Nandha from Nationwide Insurance, and J.F. Berry from WP Global Partners. And many of you will be familiar either with them personally or with their groups. And these are representing a very interesting set of institutional investors who are all active in some form in co-investing with different approaches. And what I hope today is we're going to get some different perspectives from the panel on best practices and the ways that, as an LP, you can think about a co-investing program and look at actual real-life experiences, some of the do's and don'ts, and what approach you might want to take to setting up a co-investing program, and what are some of the best practices around that program. So with that, I'm going to dive straight in, and I'm going to ask each of the panelists in turn to introduce themselves briefly, and then actually to give us an overview of their program. And it's an opportunity for each of our participants on the panel to talk a little bit about what their program entails and what the purpose of the program is. And I think out there's different reasons that someone might undertake a co-investment program. Sometimes it might be they want to reduce fees, they want to increase their returns, maybe they want to add some hedging or concentration to their program, etc. So with that, I'm going to start, and I think I'll start with Will Scott and ask you, Will, if you could briefly describe your co-investment program and what's the purpose it serves in your organization.
Okay, thanks, Chris. So I'm Will Scott. I'm portfolio manager of the CPP Investment Board. I've been here for about 8 years. Working in various private equity strategy roles and also in the direct private equity team. So your question, Chris, around what does our private equity program look like and how does co-investing fit in there? Currently, our program is about $40 billion US, about half in funds and half in direct private equity investments, including co-investments. And that's rapidly grown over the last 10 years. When we started actively investing on behalf of the Canadian public, or in the early 2000s, that portfolio was non-existent. So there's been rapid growth, and our strategy is very much to kind of increase and balance the proportion of co-investments in our program. Obviously, when we're dealing with that much money, we'd prefer to have non-fee-paying investments as opposed to fee-paying investments, but having a core funds portfolio is very important to our program. I'm sure I'll get into more details as we go through the rest of your questions, but I'll leave it there for now.
Okay, great. Thank you, Will. Appreciate. Hitesh, perhaps you can go next in terms of how your program is structured and compares, and what's the core purpose behind having a co-investment program for nationwide insurance.
Sure. Thanks, Chris. So I'm Hitesh Nandha. I'm part of the private equity group at Nationwide Insurance, and I'm responsible for co-investments. I've been at Nationwide for 10 years in various roles, mostly within the private equity group. Our co-investment program is, approximately 5-year old. We've been building it over the years, and currently we have around 15% of our NAV, private equity NAV, in co-investments. It's North America, U.S. focus. Currently, we are starting to look at Asia, for co-investments. And the primary purpose is to enhance economics of the overall private equity portfolio with no fee, no carry on co-investments, and then also to get closer to our top managers, deepen that relationship, which obviously helps on the primary fund underwriting side as well. But at the same time, we are mindful of economic cycles, macro conditions, so we are striking the right balance in terms of having the concentration risk, kind of taking it opportunistically, and then enhancing economics of the program.
Very good, thank you. And JF, also to introduce yourself and maybe talk a little bit, as a different group here in terms of you obviously have clients where you're providing them access, but if you can talk about yourself, your program, and how that fits to your client needs and expectations.
Yeah, thanks, Chris. So as a quick backdrop, WP Global is a $3 billion private markets firm. We're focused exclusively in the U.S. in the small to middle market area, and our clients are mainly large sovereign wealth funds, public and corporate pension funds that use us to scale down into the U.S. market. So over the last 20 years, my partners and I have collectively invested, a little bit north of $5 billion into 420 plus funds, and we've invested over $800 million, actually into 105 direct transactions, most of which have been co-invest. So, with that as sort of the framework, I would say almost everything we have done over the past 15 years on behalf of both our separate account and our commingled clients has involved an allocation in some form or fashion to co-investments or direct deals. So co-investing is a big part of our culture and a big part of our strategy. You'd mentioned the comment about do you use it to reduce fees. I would note that we do not view co-investing as merely a means for reducing fees, but rather as really an integral way to capture alpha by proactively targeting certain industries, certain business models, as well as accelerating the capital deployment for our various clients around the world. So, and my last point, and I think all the panelists will probably get into this in a little bit more detail, but there is a big triangulation effect between fund investments and co-invests. And we've learned over the last 20 years that working on transactions and co-investing with a sponsor is in our mind the best way to truly get to know a sponsor and do fund due diligence to understand how they source deals and how they manage risk through the life cycle of a private equity investment. So hopefully that's just a little bit about WP and how we view co-investing.
No, that's great, and thanks to all. And I think that topic of a symbiotic relationship maybe is a really important one, both directions, and it's interesting you mentioned that, Jeff, and as you say, I'm sure we'll get more into that all together and with Hitesh and Will as well on their thoughts on that. I'm going to take a little segue here for all of us in terms of some of the analysis we did, and what we did here, as I said at the beginning, we do some work with a lot of institutional investors, many of which are co-investors. And as part of that, we track how those co-investments, where those co-investments have been made and the outcomes of those co-investments. So we did an analysis as part of the lead up to this, and I'm going to just go through some of that and then ask you guys on the panel some questions and your thoughts, and maybe you have a different perspective than what we're going to show because of your own unique programs. So for everyone, just as an overview of the actual data that we analyzed across all of our client relationships, it ended up being just short of 4,000 co-investments. So it's a very large pool of data that we're looking at. On the contrary side, later I'm actually going to show some kind of benchmarking against non-co-investments. Overall, we have data and outcomes of about 45,000 individual deals. So in this, it's about just short of 10% we see in terms of the visibility we have to the market. So it's a pretty big pool to do an analysis on. But this analysis is a little bit generic in nature. Obviously, you could get into all sorts of different slices of the market. What we can see here of that just shy of 4,000 deals, there's a huge emphasis onto the North American market. And we think that's partly because of the maturity of the co-investment opportunity in North America, but also maybe it's due to a certain level of concentration of people and the opportunity in the market. Second to North America with just over 2,600 co-investment deals. We have just about 850 in Europe, 192 in Asia. Global is effectively deals that are with companies that are global companies, so multi-domiciled, probably at the larger scale, and then rest of world being broadly emerging markets outside of core Asia. What we see as a mean, so a statistical mean of the size of a typical co-investment is 16.3 million. Obviously, as a mean, you get a certain amount of outlier capital weighting to that, and we'll get into more details of actual sizes of co-investments. And then the actual total amount of invested capital that we see from co-investments across all of our client base is just about $69.5 billion US dollars. And that, when we're talking about that money, we're talking about that is the figure that an actual investor has put on the table as a co-investment transaction. So alongside a GP investing, the total amount of capital we've seen flow into co-investments across this period, which, by the way, is from 2000. This analysis is based from the year 2000, is $69.5 billion US dollars. So it's definitely a large part of the market, although it's not on the same scale as would be for direct or GP deals themselves. Another emphasis that we see is we did an attribution or a kind of analysis of number of deals by strategy, and we can see here that a very large majority are coming through from buyouts. So that seems to be a focus of the market, but again, the panelists can talk to their own programs in a minute. So we see North American and buyout as obviously being a big focus area, and then here, as you can see, followed by private debt, growth, venture capital, etc. In terms of sector focus, it's a fairly broad spread, but there's definitely a focus towards the core of consumer and industrials. Partly, I think this is due to the actual market itself, and there tends to be a higher proportion of buyout deals, for instance, in consumer and industrials, and then followed by technology. Interesting, there's quite such a large amount of healthcare in there as well. And maybe, again, the panelists in a moment can talk to whether they have a sectorial focus and where those opportunities might lie. And on this, we're looking at the actual number of co-investments by year. So there's an interesting trend line going on here. Obviously, it's been a significantly growing opportunity in the market, and it grew to a peak just before the global financial crisis. It makes perfect sense that it fell away after 2007, partly, again, because the whole market fell away there, and if we overlaid this on the market, we would also see a fall away in the amount of deal flow in those years of 2008 and 9. But then interesting to see the dramatic increase in recent years where we're getting up to a much larger number of co-investments being executed in the market in recent years versus going back to the early 2000s. So it's definitely a trend of the market, and this is why a session like this I think is so valuable for people to get into the weeds. Looking now at the size, this is the size of the co-investment. So rather than the size of the deal or the company, this is looking at how much money an LP is potentially putting into a co-investment. And we see here the large majority are at the smaller end of the market, where they're co-investing alongside the GP with 10 million or less. And again, a fairly large group at the 10 to 50. If you add all that up, it shows, I haven't worked out the math, but it's going to be 80+% of co-investments are at the between up to 50 million. And then it's a much smaller proportion who are doing the larger scale deals. And, perhaps there's some comments on that as we go forward as well. And by enterprise value of the companies, we see a reverse effect here. There seems to be a more of a focus on larger companies to co-invest. There's quite a spread across the smaller and the mid-sized part of the market, but definitely the emphasis appears to be on larger companies. Perhaps that's because they're perceived as being a lower risk for investors or a better opportunity. But we see fully about a quarter of co-investment deals are for companies with an enterprise value greater than $1 billion. So again, that shows an interesting nuance to the market. And lastly on this section, before I go back to the panel, is looking at the actual distribution of multiples, so really a performance distribution of how co-investments have actually performed in the market. And we're going to come back on the performance topics in a while. But this is really showing on a typical basis. And by the way, this includes realized and unrealized. So if it's an unrealized co-investment, we would take the current valuation. And as everyone knows, in many cases, that might be carried at cost. But this is showing a focus of distribution of returns at the low teen multiples. And this will obviously, as a co-investment, this will be gross returns. So subject to whatever structure of fees and carry might be applicable to that co-investment is taken out of this equation. Now, with that, just as an overview of how we see and have seen and the analysis of the market, I'm going to put to the panel now the question, based on that kind of overview, and I shared this with you before, obviously, what we're seeing here is a focus towards North America, a focus towards buyouts, and a focus towards a smaller bite size but in larger companies. What I'd like you to do, each of you to do, is really think about in the context of your program, is that your experience? Are you focused in those areas? Or are you looking at it in a different way? And how does your program compare versus that overall market perspective? And maybe with that one, let's start with JF, because you were talking a little bit earlier also about where your focus is towards the mid-market.
Sure. Thanks, Chris, and those slides are terrific. I'd say since most of our fund investments are with small to lower middle market U.S. buyout funds, if you were to look at the majority of our co-investments over the years, they tend to be in this area, sort of equity size of 5 to 15 or 20 million. We have done some growth equity investments, so that might be a little bit of a differentiator compared to what you're seeing in the marketplace. I would say, as a thought to those that are listening in and thinking about developing a program. These numbers can be intimidating. There is certainly a lot of co-invest capital out there. There's a lot of LP capital. I would throw out to the panelists as well as everyone on the phone to think about, if you are starting from scratch, think about targeting certain industry sectors, certain business models that might be a nice complement to your existing public as well as private equity positions. We have found over the years that GPs are fairly unresponsive if you just sort of check the box in the LPA and the subscription agreement, and you just attend annual meetings looking for co-invests. On the other hand, they are very responsive, and they truly can be very close integral partners if you bring some knowledge, some deal flow, and some passion towards certain industry subsectors. And again, something we can talk about later. But the other key is if you're willing to roll up your sleeves and jointly work with your sponsors in very targeted ways. So I guess my overall commentary is, if you're thinking about getting into this space for the first time, whether you do it on an in-house basis or outsourced, think about targeted subsectors, think about targeted business models rather than just canvassing all your GPs and just trying to do buyout transactions.
That's a good thought. Hitesh, check the box, or have a focus and be, as Jeff said, look at specific areas that you have a passion about. What's your approach?
So we have focused on buyouts in the U.S. So I think, Chris, your slides show data that, that's kind of a reflection of what we do. And our focus is buyouts in the U.S. And our bite size is anywhere from $10 to $15 million. And in terms of like sectors, we are sector agnostic, but we don't do co-investments on the real estate side. That's a separate group. But outside of that, consumer, financial services, healthcare, technology, TMT, all those spaces are interesting to us. And we only co-invest with our underwritten managers. So, the established fund platform, mainly in the U.S., where we have long-term relationship, we have the best managers. We have a subset of our existing managers identified as core managers for co-investments. And these managers have pretty strong, consistent track record with low loss ratio, low dispersion of returns, and good relationship. So we build on that. And then over the last 5 years, we've also built a good fund platform in Asia. So that's where we are looking to do co-investments more in developed Asia. And in Europe, we have a platform as well, but we've been highly opportunistic there. In terms of company size, I'd say that we are on the larger end of the market. We like market-leading companies north of $25 million in EBITDA, and with strong cash flow characteristics that can weather a downturn. So our sweet spot is actually larger end of the market, but not mega buyouts, but I would say upper mid market and large buyouts.
Good. So relationships. It sounds from both of you there, and actually, Will, this leads back to one of your comments at the beginning, that relationship as well with who are you going to get into bed with. Maybe you can talk to that a little bit in context of your program. So it sounds like don't click the box, don't just make the check mark. You really have to know the manager, and also, Hitesh, I think what you're saying is know the opportunity and get into that. So Will, maybe from your perspective, again, in terms of, I think it was interesting, we've got 3 different programs here. Maybe you can talk a little bit about how you see it and the types of relationships and sizes and focus areas you guys have at CPPIB.
Yeah, I mean, one of our challenges here is, given the size of our program, how to scale a co-investment program. And so in your sample, there's a lot of smaller deal sizes, but getting pieces of bigger companies, if I understand the data correctly. Our challenge is getting larger pieces of transactions, and that ultimately means I think that we probably invest in larger companies than average in our co-investment portfolio. I mean, our bite sizes range from 25 million up to 275 million for our co-investment program, which is a huge spectrum. And so it really comes down to the challenge of scale and making sure that, which means that we can't really be that picky when it comes to specific sectors or geographies. In fact, what we're trying to do is create a well-diversified portfolio across multiple geographies and multiple sectors, realizing that most of the activity occurs in the U.S. and most of the activity in private equity is in the buyout space, so that's where our portfolio is going to be concentrated. Again, I just come back to the challenge of scale means that you need to build very strong relationships with GPs and have a solid fund portfolio that you've committed to, ideally multiple funds with GPs over the course of a decade, which is kind of how we've built our program.
And going back to a point JF made there, Will, about the two-way relationship, do you also push that back, the experiences you have on the co-investments, that you reflect that back on also the managers on the fund side where you've got that split program going on?
Yeah, for sure. I mean, it's great to show the GPs that you can differentiate yourself as a co-investor. I mean, we have a pretty big co-investment team with pretty sophisticated investment professionals at our fund that are kind of willing to get right in there and, as JF put it, roll up their sleeves and show that we're happy to do some of the heavy lifting ourselves if necessary.
And that's a really good segue, I think. I'm going to go on to the topic of what should an LP be thinking about, what factors, an LP who's considering a new program, what are the factors they should be thinking about? What are the positives and negatives that they should consider? And I'm going to also we had a question coming via the audience, which is asking about fees and carry in that I think it's part of that topic. And Jeff, you already referred to that. But maybe we can start off. Let's start on this one maybe with Hitesh. Could you talk about when you guys undertook to have a program? I'm sure there's lessons learned there. If you were talking to an LP now, and giving them some thoughts on what they should be thinking and planning for, what would be your recommendations to an LP starting a new program right now to think about?
Sure. In terms of the reasons to get started, some of the positives are clearly having no fee, no carry. That helps in enhancing economics. But I agree with JF in terms of kind of the deal selection ability and kind of creating alpha. So co-investments can be a meaningful contributor to returns. And then in addition to that, it's a great way to engage with the GPs, get closer to them, and really see how they work and manage difficult situations, create value. And that insight is quite helpful in the primary fund underwriting as well. So it's kind of complementary to the fund platform. And then we can also control the deployment of capital using co-investments as opposed to blind pool fund investing. So if we believe that we are on the attractive side of the economic cycle and we see good opportunities, we can deploy capital in those opportunities quickly. I think on the challenges front, that's something that every LP should be aware of, is that there is significant concentration, so that will obviously affect the sizing of such co-investments. But on the co-investment side, there is a risk of complete loss as opposed to a fund investment where that is very less likely. And then there is this risk of adverse selection. As Chris showed, there are many co-investment deals available right now. So when markets are rich in pricing, frothy market, we tend to see more co-investment deals. So if we do more at such times, that there is clearly adverse selection. So we have to be highly selective. And then there is clear difficulty in sourcing deals in such a highly competitive market. So that's one of the challenges, and I think that's where as an LP, we need to differentiate in the marketplace whether it is by the strategy that we operate or how can we be a value-added partner. And then I think internally also on the co-investment side, it kind of puts strain on resources. There are accelerated timelines, so that that will affect the decision-making processes as well. So it's those are the challenges that one should be aware of.
Now I heard something there, Hitesh, subtly. Just like to ask you about. It sounded like you're saying, to a certain extent, you're putting yourself on the line more for a co-investment because you don't have. There's a higher risk. That yes, you can have higher success and concentration, but if there's a loss, you're carrying more of the responsibility there. Do you perceive it that way?
That's right. Yeah, it is clearly kind of putting yourself on the spot and making these tough decisions. So yeah, it is a higher risk game, and I think that's where we make sure that we are collaborative internally. We have an internal credit research group and a lot of talent available. We have a private debt group as well, and we do co-investments both on the equity side and debt side. So we make it a team effort. We leverage all the resources, and unlike CPPIB, I guess our program is opportunistic, so we can afford to say no to every deal if we want to, and be highly selective. So I think those things clearly help. And then I think on the, I think the other thing that excites the team is, even though it's more risky, I guess, but there is this learn and grow kind of build this capability in house, and then I think as it feeds the primary fund underwriting, and also I believe that this is a good way to build a secondary capability because the underlying assets so well that you can even buy and sell the secondary fund positions more effectively. So I think there are these other strategic advantages that you can take advantage of.
That is very good.
Chris, I would jump in. It's J.F. Berry. In terms of, I just wanted to expand upon one of the thoughts that Hitesh mentioned and broached in terms of what do you need to think about. And, over the years, it's our experience that co-investments can be very visible to your clients, to your investment committee, to your board members, both in a positive, also in a negative way. And I think if you're thinking about building out your own direct program, it's key to manage the expectations of your constituencies, because it's one thing to see quarterly reports and see great performance from fund managers, but when you're in the weeds on a direct deal, I can assure you that no deal goes perfectly according to plan. And so even if you get the business model right, the sponsor right, the trends are in your direction, there's inevitable product launch delays, lost customers, margin compression. So, the biggest consideration I think new entrants into the area should think about is making sure that all your constituencies understand that things do not go according to plan. Management budgets are, often not achieved. And as sort of part and parcel to this thinking, another factor to think about is that it's not just a one investment and then watch. Value can be very quickly eroded and lost if you don't participate in follow-on rounds, down rounds, equity make-wholes when there are problems. And conversely, you can gain a lot of ground by doing more than your pro rata share of down rounds if there are issues with the co-invest. So a key point here for those on the phone is to be prepared for problems, manage your constituencies, and then as part of the process, make sure you have adequate reserves to support your co-investments for add-on acquisitions, down rounds, and so forth. Because if we look back, and I wish I had the number, but I would say we've probably made over 200 distinct investments if you count all the follow-on rounds and down rounds and so forth.
No, it's good. And what we're hearing, I think, is it's not a trivial undertaking. The devil's in the details. Well, I think you guys are, as you've already said, and we're aware you're a very large-scale investor. Maybe you want to talk a little bit in the context of that about what the setup that you would be recommending to an LP for a program, maybe not on the same scale as yourselves, but I think the lessons learned are the same, and as JF and Hitesh have been talking about. What are the sort of things you need to have in place to be successful on this?
So I think it gets to some of the points that have already been touched on that I mentioned earlier about having key fund relationships early. So you want to be building those and ideally have fund commitments in place and not have the expectation that you're going to, if you make a fund commitment, co-investments and you check the box on the LP agreement that co-investments are just going to start coming in. You need to ideally have some kind of value-added angle for that GP to pick you for certain co-investments, and then the GP to have confidence that you're going to be there to transact and be willing to move around tight timelines in a dynamic environment where budgets will be changing and underwriting might be changing, and that you're going to be able to get to the finish line in most cases. So that's kind of, are you able to transact? Do you have the relationship in place? And is there a reason for the GP to give you a call for co-investments in the first place? And getting to JF's point around kind of liquidity reserves and being able to fund into co-investments and have kind of a pipeline set up for unnamed deals. So be prepared for co-investments that are coming down a pipeline. If a GP knows that you have the liquidity, that's going to go a long way when they're thinking about who to call.
Okay. So it's not as we said, we're all hearing here, it's not a trivial undertaking. I'm going to take a quick segue for a little bit more analysis. We've got a bunch of questions which have come in, which I think also will fit to get into. But we already looked briefly at the multiple distribution. Again, to emphasize, this is realized and unrealized, and at the core of the market, it seems to be, and I think this is back down to not selection bias, but the selection of the LP, making sure that you're getting into the right co-investments, I think is what we're hearing from everyone, the right relationships, the right reasons to co-invest, and the right co-investments. I did want to share a couple of, again, I don't know if this is clear to everyone, it's maybe a little bit hard to see on the screen, but the general performance that we've seen, and this is looking at pooled performance. So just to explain to everyone what that means, we're pooling the underlying cash flows of those individual co-investments to say as if you were invested in every co-investment in North America effectively on a capital-weighted basis versus you were investing through a GP on a gross performance basis, so excluding any fees and carry. The general trend that we see on a pooled basis is that the results of investing via a GP, via a professional organization, generally on a growth basis are better than investing through a co-investment. And what I would maybe conclude from that is where it's a check-the-box type approach, it's maybe not working out as well as someone might consider. Secondly, I'll go on to another one, looking at it by stage, and we did actually have a question come through from someone on what the venture capital experiences have been in terms of co-investing. What we actually have seen is for venture capital, it seems to have a better outcome than other parts of the market. And again, maybe that's a level of selection. I don't think, and maybe in a second I'll ask the panel if any of them have experience co-investing into venture. But it's actually one of the strategies where we've seen a positive outcome for co-investments is in venture capital, where the pool results have actually outperformed. And it'd be interesting to hear perspectives on that. When we're looking at investment size, what we actually see is at the smaller end of the bite size, there tends to be a better outperformance. And I should have explained on each of these charts that the striped bars are the co-investment performance, the solid bars are the performance of directly GPs investing via funds and having the GPs' gross performance of their deals. So we see a better performance, interestingly, at the lower end. But again, I think there might be some level of selection going on in there. And again, it's back to the ability of an investor to choose the better relationships and the better co-investments, not just check the box. And we have another multiple one here. Interestingly, it's the disparity between IRRs and multiples. Typically when you see a disparity where a multiple has a better performance than an IRR, it's down to the cash flow timing. And maybe this is indicating a level of patience needed to make returns from co-investments rather than expecting them to turn around too quickly, because overall we are seeing better multiple performance, whereas before when we looked, we saw that there was a lower IRR performance. So what I think I'm conscious of our time, and I want to get in some of the audience and some more perspective from the panel. But I think what I've summarized in terms of the analysis that we did across the co-investing market versus the GP-driven market, it's not a simple equation, and as everyone on the panel is saying, I think it's got to be a thoughtful undertaking rather than just I'm going to co-invest or I'm not going to co-invest. The nuances of the market have to be taken into account and have an intelligent view of that. Now with that, I'm going to actually go to some of the questions and try and do a quick fire here to make sure that we cover some of these. We had a couple of questions about fees and carry, and I want to put that on the table and just ask briefly each of you in turn, and maybe this is more a question to Hitesh and to Will, to make sure or ask you, are you typically paying fees and carry on your co-investments, or is that something you don't do? So Will, for you guys, is that a topic for you? Is that something you can comment on?
I mean, typically the co-investments have less fees and carry or no fees and carry, and it's something we aim for. Can't really comment on the details.
Okay, and Hitesh, for you guys, is that a similar situation?
Well, we pay no fee, no carry on co-investments, and that's pretty typical for buyout deals. I think if it's sidecar vehicle by the GP, there is usually some fee and carry, and maybe for existing LPs they may waive fees, but they do charge carry on those vehicles, and we don't go through those vehicles. Our preference is to directly invest in deals and save fee and carry.
Okay, and Jeff, I think this segues into a question about, because you're providing more of a kind of, if you like, managed account approach here. So you're providing access, as you said, to your clients. kind of another approach to this. What would be your comments in terms of an investor? Should they be going to, I know it's a loaded question, but a group like yourselves, is that a good starting place to start a co-investing program with a lower overhead of staff and execution ability needed? And what's the implications, in terms of that question about fees and carry? What do you see as the trade-off there?
Yeah, I think there's two keys to consider for any new entrant who's thinking about building out an in-house program. And I think you've heard it from all the panelists today. The first question you have to ask is, do I have enough LP dollars in the marketplace? Do I have enough LP dollars versus other LPs? And do I have the relationship to generate deal flow? I think that's first and foremost they have to think about. And then secondarily, do you have one or two professionals or a team of professionals that can proactively work with sponsors on a regular basis, get on the road to source deals, and who can work late nights, weekends to arrive at very quick decisions if you're in the throes of a live deal. You're talking to some very terrific professionals at these big organizations. They all have direct private equity backgrounds, and you can tell by the tone of the conversations that they've been in the weeds on direct deals for years. So if the answer is no to either question, then you should consider finding third-party partners for support, because at the end of the day, co-investing is much harder than most people realized. In order to generate lots of deal flow, you have to be viewed as a perpetual source of fund LP capital. One of the keys to success is to turn good deals down and to be very selective and have opinions. And then I think all of us on the panel would agree you have to have a team that's willing, I guess to use my expression early on, roll up your sleeves, get into the trenches, and make some very proactive decisions and do your own modeling, your own due diligence, because you don't want to be in a situation where you're unintentionally subverting a deal because a sponsor at the last minute has to replace your capital to get a deal done.
That's good insights. I'm going to keep going through the questions, Q&A coming in. We've got lots of other potential topics, so I want to make sure we're responsive to the audience here. And I'd like, on this one, I think a yes-no answer is, have any of you done co-investments with GPs that you don't have a fund relationship with? Is that a possibility for you? Will, have you done any deals where you have no relationship with the sponsor of the deal?
I have to imagine we have. I can't think of one off the top of my head, but it's definitely it's a very rare instance for us.
So on an exception basis, if there was an opportunistic case which you were really felt was very high value, but it's not your common approach. Correct. Hitesh, for you guys?
Yeah, it's the same way for us as well.
And Jeff?
I would say that we're slightly different in that, given our focus is on, the smaller funds, we do a lot of lift-out teams on the fund side. I'm trying to think if there's a deal that we've done, and I don't think that's a case where we don't have a fund relationship in the end. A big driver for us is, who are the people and who's lifting out. But for the most part, there has to be some sort of relationship. We do not randomly co-invest with groups that we've never worked with, let's say in a prior fund formation or fund capacity.
Okay, and I think it links into another question we have from an audience member about deal flow. I think the summary seems to be it's very heavily relationship driven, and having strong and positive relationships with the GPs. Do any of you have particular challenges of creating those relationships, or is that just a matter of spending the time and making the commitment over a period of time? Maybe Hitesh, you can comment on that. Challenges on the deal flow side.
Sure. Yeah, I think it requires some proactive work to create the deal flow, and I think as we've talked about quite a bit, there is a need to have a pretty matured fund platform, and having this long-term relationship with managers, and then that's the starting point, and then we obviously do our own work in terms of what we like, and as I said, we prefer managers with low loss ratio, low dispersion of returns, and then targeting upper mid-market, large buyouts, and those are market-leading companies. So once we do that, then I think there are some levers that we can pull to create this deal flow. One is obviously having a meaningful bite size for fund investments, but in addition to that, it's important to create a good relationship. So that requires some work. We obviously have constant dialogue with our preferred GPs for their pipeline, and have periodic meetings, engage at all levels of the organization at Nationwide as well, and then understanding the GP's need and being a good partner, understanding their capital need, timing need, and saying no quickly with a thoughtful response. And if it's yes, then being completely transparent, highlighting issues, and getting there on time. And then the other thing we highlight is Nationwide as a differentiated LP. So we can do both equity and debt co-investments. We have a separate private debt team that's pretty active. And then in addition to that, we have our parent organization with multiple financial services businesses. And the portfolio company could have different types of relationship with Nationwide. Could be an IT service provider, or maybe a customer of Nationwide, or it could be an interesting business segment in the financial services space where we can leverage Nationwide's distribution. So there are multiple ways to add value with Nationwide businesses as well. So we kind of bring all these things together and be a value-added partner.
So that's an interesting one, because there you're talking about corporate strategy, not just as an investment shop, that not just the relationship with the GP, but the potential relationship with the actual target company. You like to see some synergies there, which I think is a really interesting angle to think about. We have another one, which I think is a good one maybe to come towards the close, because we're running out of time, and we could probably spend another hour and still be getting questions. But execution, we have a question here, which is about execution. It is operational due diligence on co-investing deals. I think, Will, maybe if you don't mind, you can give your perspective on this. To what extent are you relying on where the co-investment is coming via a relationship? You have a trusted relationship with the GP, with the manager. To what extent do you rely on their execution ability, their due diligence in all aspects of that, versus your own teams taking that on board? Maybe you can kind of comment on,
Sure.
on what it takes to do that.
Sure. I mean, ideally, you have a full your own kind of private equity due diligence team to do the diligence in your own way, but that's expensive, hard to set up. Not everyone has that. We sometimes have that, and we will use that to the greatest extent possible especially with bigger co-investments. We will go in and do almost a full set of due diligence ourselves. But there is situations where for smaller deal sizes, you kind of need to tone it down. You can take some of the GP materials, due diligence materials, and synthesize them and get comfortable with the investments. And depending on whether or not you are comfortable with the diligence that's been done, you can make a decision there. So I think it depends on, do you have the time and resources to put it in? but I think unanimously everyone would say, yes, we would like to form our own opinion on whether or not we're putting millions of dollars into these individual companies.
What about on the topic of legal due diligence and making sure that the shareholder agreements, et cetera, are put together? Do you use then an internal counsel, an external counsel? Is that a big overhead for you?
It is, and it's just, I think, part of a necessary part of doing co-investments is that you need to have counsel advice, whether it's internal or external. You'd prefer to have it internal, but having a team of lawyers specifically dedicated to co-investments, I mean, we don't even have that. We're one of the biggest co-investors out there, so oftentimes we'll rely on external legal advice when they're vetting all of the transactional agreements that need to be vetted.
JF, do you have anything to add on that topic of execution and what you need to make operational due diligence and do your homework?
Yeah, I do. I think there is a lot of value in doing some of your own supplemental research. That does not mean doing a second layer of Q of E and industry reports, but really working with the sponsor, identifying an area of risk or concern that your team would like to look into and being a collaborative partner. So that's part A. We're big believers in building your own models and understanding sort of the downside, the downward model side of things. But lastly, I'm assuming most people on the call are LPs and have capital with a lot of sponsors. And so if the deal is signed up under LOI, think about using your network in your ecosystem. We have found over the years that sort of delving into the network, you can always find sponsors that have looked at similar deals in the past, retired executives, expert networks and so forth. And so doing some of your own due diligence using your network of LP dollars, we have found to be extremely helpful and sort of complementary to the lead sponsor's due diligence efforts.
Very good. Thank you. I think we're coming towards the close. I want to, first of all, apologize for anyone who asked questions. We had a lot of very good, deep questions, and I apologize that we couldn't cover all of them. There is a survey, I think, that SuperReturn are sending around where people can give feedback. Maybe one of the feedbacks is that we need a follow-up session, given the amount that we covered and the amount that we didn't cover. I would really like to thank my panelists. It's been a great session. I think some really interesting thoughts. Will Scott from CPPIB, Hitesh Nandha from Nationwide Insurance, and JF Berry from WP Global Partners. I think everyone will agree that they gave a really interesting perspective. To me, after hearing everything, and this wasn't so much of a scripted session versus trying to get under the covers, I would maybe summarize to think about for those LPs thinking about a program. You've heard the relationship is key, the sourcing of the deals, which is very relationship-driven, the understanding of what you're getting into, and then I think the execution. And maybe we could have spent more time on execution because I think that's some key topics there. And maybe that's a choice as to whether you partner with a professional organization or whether you can take on in-house co-investing, that your ability to execute and have a team able to dedicate their time to the efforts required, I think is extremely important. And that will be one of the takeaways that I would take from listening to this expert panel here. I'd like to thank all of the attendees, all of the people who submitted questions. It was some great interaction. And with that, also thank the SuperReturn team for setting this up. And I hope that we can have some interesting follow-up sessions. Thank you very much, everyone. Have a good day. A good evening for those joining from Europe. Good afternoon for those in North America. And look forward to seeing you all, or some of you hopefully in San Francisco at the Super Return Conference, and have a good weekend. Thank you very much.